10-year US Treasury yields briefly breached the 5% level. Now, people listening, you might be thinking, sure, we know that interest rates are higher. What's the big deal? But actually, it's quite important, isn't it, Dean?
It is indeed, Tom. So when we say a 5% yield, that's basically the return you get on a bond for holding it to maturity. And for the 10-year US Treasury, that's the highest it's been in 16 years.
So 16 years from an investment market perspective is an absolute age. But why are we focusing on the 10-year US Treasury bond? What makes that so special compared to other bonds in the market?
Yeah, that's a good question. So the 10-year US Treasury yield is the number that markets watch. It's essentially the centerpiece of the global financial system and helps sets the price for all sorts of loans and investments. It's not just theoretical, it has real world implications. For example, it'll impact how much somebody in the US pays for their mortgage. It'll influence the cost of, say, borrowing for businesses to build that new factory. But why is 5% important? Well, it's effectively a psychological high watermark, which has now been breached.
Okay, so there's nothing magic about the number 5 apart from that it's just a psychological factor that's at play. But let's just talk about why the actual yield did breach the 5% level. What's been pushing those yields up higher?
Sure. So there's a couple of factors. First, the US economy has been remarkably resilient. If you can believe it, the unemployment rate is at 70-year lows. While that calms concerns about an imminent recession, it does potentially keep inflation higher for a bit longer, with the knock-on impact that the Federal Reserve will probably keep interest rates higher, we think well into 2024. Second, there's also an element of Treasury yields that represent what investors are willing to pay for longer-dated investments, known as the term premium. These two factors are important because as an investor buying a 10-year US Treasury, you're going to want a higher yield as compensation for these risks.
Definitely. So higher yields. So what's been interesting so far this year is the consensus just shifted a little bit. So at first, people thought there would be interest rate cuts towards the end of 2023 this year or early into 2024, but it keeps getting pushed out. The concept of interest rates remaining high for longer is becoming more of a consensus view. But what does that mean then for these 10-year Treasury bondholders or bondholders more generally? Is that a good thing or a bad thing?
Sure. So in the shorter term, higher yields have driven down the price of existing bonds. They're usually considered a safe haven investment, providing performance during periods of uncertainty, but they've not really been displaying that characteristic of late and have actually been quite volatile. Having said that, as a multi-asset investor, bonds are now offering much more attractive forward-looking returns than they have done for many years.
Okay, you know I'm going to ask you now. It's the multi-million-dollar question. So 10 US Treasury yields breach the 5% level. Is it going to go higher or is it going to sink back below that level?
So a lot depends on the future trajectory of inflation and the US interest rates. Our view is that central bank interest rates probably have reached or are close to their peak levels, but that doesn't necessarily mean that mechanically 10-year US Treasury yields have got to come down. Though, as I mentioned, they now offer much more attractive returns looking into the future.
Okay, so 2022, as we all know, was a pretty terrible year for bond returns, one of the worst on record. 2023 hasn't exactly been plain sailing either, so we'll be looking at 2024 to see what happens. Dean, thanks as always for your time today. Interesting stuff. And of course, thank you for everybody for watching. And we'll be back again next week with another episode.